Pops, the alarm bells are ringing. There's a credit crisis in the auto industry, and Wells Fargo just rang an alarm bell. We've got loan-to-value ratios that are absolutely insane for subprime borrowers, and this is really scary stuff. Can you explain to us what loan-to-value is and why their 150% LTV loans to 550 credit score folks is a bad, bad scenario?
Yes, loan to value is the amount that a bank will finance based on the value of the vehicle. So if the value of the vehicle is, say, $10,000, and the bank says, we'll finance up to 150% of the loan to value. So that would mean that they would finance up to $15,000 on a vehicle that has a $10,000 value. Now, why is that a bad idea to somebody that has subprime credit? I don't know. They've already proven over the course of time that they can't handle the credit they've had. And now you're going to put them into a loan where the instant they sign and the instant they drive off the lot, that they have as much as 50 to 60% negative equity associated with that loan.
Okay, so as we get into the Wells Fargo story here, the important thing for everyone watching this video to know is the higher that loan to value ratio, the worse for the customer. Typical loans should be 80, 90, 100% loan to value because people are putting money down. We've got some data from Edmunds that also shows how scary things are when it comes to down payments. So Dad, we've got 150% loan to value ratios. That's bad. Even if you have super prime credit, that is bad. But what decision did Wells Fargo make here, and why does it make this so damning?
Well, they decided that they want to increase their loan portfolio, and they're willing to take on riskier loans in order to accomplish that. And so how do they do that? They're agreeing to finance upwards of 150% of the value of the vehicle to people with suspect credit. Now, if your credit score falls below 550,
540, Dad.
540, they'll only do 110%. Oh, isn't that gracious of them? They shouldn't be doing the loan at all. So we're saddling people who already have bad credit with loans that are filled with negative equity. I mean, what could possibly go wrong here other than the fact that these people who have had a hard time in the past making their payments are going to have a harder time in the future making their payments? And if and when their vehicle gets repossessed, the amount that the bank will be able to sell it for in relation to what is still owed is, well, significantly below what the loan balance is.
So Wells Fargo also increased their loan portfolio by 87% year over year for the most recent quarter. So I guess one of the takeaways from if you've watched this video is if you're trying to get approved for an auto loan with really poor credit and you're trying to get approved for an auto loan that's at 150% of the value of the vehicle, call up Wells Fargo. Seems like you'll probably be able to get an approval. But Dad, to your point, that's actually bad news for the future of the auto industry because we already are in an environment where the loan loss provisions that these finance companies are providing, they're going up. The auto loan delinquency rates are the highest we have ever seen, not just post-pandemic ever seen, not just post-Great Recession, literally the highest auto loan delinquency rates we've ever seen. Repo companies, there are not enough of them to repossess all the vehicles that these banks are trying to get back from customers. So this is a scary time for Wells Fargo to be going out there, increasing their loans by almost 100% year over year, and then also being super lenient, which it's not just Wells Fargo. Ford, at the end of September, they introduced a program where they were approving loans at their subvented, so 0%, 0.9%, 1.9%, those specialized interest rates for people with subprime credit as well. And we've heard Nissan's doing the same thing. So this is across the spectrum. There's a credit crunch and a looming credit, you know what? Not looming. We're in a credit crisis, but an even worse credit crisis that could happen down the line.
And we're in a situation where we're seeing more and more loans that are delinquent. And rather than repossess these vehicles at this particular moment in time, many banks are working on loan modifications and loan extensions to make it easier for the customers who have already fell behind on their loans to, well, continue to make some type of payment on that loan, so that they can avoid having the vehicle repossessed. Because the banks know that if they were to repossess the vehicles, that the value that they get for that vehicle at the auction in comparison to the balance that's owed is, well, significantly below that value and of what's owed. And, well, the customer is obligated to make up the difference. Well, a customer with bad credit, well, they're not going to be making any payments on a car they don't have just to cover the loan loss on it or the balance deficiencies on it. It's not going to happen. So this is a recipe to almost enslave people with bad credit into a future that will never allow them to get out of that position.
Can you also just briefly explain, like, that balance, that deficiency balance doesn't just go away, right? Like, the financing company can come after you for that. I don't think that's clear to most people.
Well, yeah, whatever the deficiency balance is, the bank has the ability to come after that person to get them to make that up. Now, the problem is that most people, if they fell behind on the car and they were actually driving something, and they're told, well, now you have to pay $200 a month to cover the deficiency balance, but you don't have a car to drive and you don't have anything to show for it. Well, those people aren't going to typically, they're not going to be paying off that deficiency balance. So the bank is just going to write that off, lower their tax liabilities. But ultimately, if the losses are so great, forget lowering your tax liabilities. It impacts your ability to stay in business.
For sure. But I just want to be very clear, folks. Banks can come after you for a deficiency balance, whether they will or not, TBD to my dad's point, but they can come after you. And I don't think a lot of people realize that, Pops. Obviously, then there is an impact on the financial institution. We are seeing, like I said, loan loss provisions go up,
Yes.
up. One other data point. This comes from Edmund's dad. In Q3, the average new car down payment fell to the lowest level in nearly 4 years, just $6,020, pushing the average amount financed up to a staggering $42,647. 20% of new car loans have $1,000 a month payments right now, and 22% of loans are greater than 7 years or longer. So that's the state of the auto finance market. You've Wells Fargo dipping super into the subprime space with riskier loans, Ford doing it recently as well. Then you have the Edmunds data, which shows consumers are taking out longer loans with higher payments and financing more with less money down. Oh, we didn't even talk about the negative equity crisis, which is people are showing up with even more negative equity. So it's a scary, scary, scary time in the auto industry. That's for sure. We'll keep you posted on the latest here back on the CarEdge channel.
Absolutely. As scary, I don't think is an adequate enough description as to what the future holds for auto finance.